I'm an accountant in Madison, Wisconsin, and I've done a lot of work with co-ops and have been to New York City a number of times to work with various co-ops there. And I've been studying a lot about the new tax law, so everybody thought it would be a good idea to do a little presentation. So the tax law that we're particularly talking about tonight is the Tax Cuts and Jobs Act, which is the one that was passed last December, and it applies in 2018. So it's already in effect for your co-op. So generally, most of your co-ops are probably December year end, so that means it will apply to your 2018 tax return that you'll be doing early next year. So that's the reason it's important to talk about this now. Some of the things have not been released by the IRS, so there are continuing issues with exact interpretations, and we may not know for several years exactly how all this is going to fall out, but it's good to be planning. So I know many of you are LLCs, taxes, partnerships, but at least some of you, I'm sure, are either LLCs, taxes, corporations, or corporations, taxes, corporations. So a few of the things we'll cover for those groups are changes in the tax rate, some things about patronage dividends, and I'll cover those briefly at the start, and then we'll have more towards the end, probably after the first half hour, but we'll see. And then changes in the net operating loss rules, which only affect corporations. And then all co-ops, including partnerships, and there probably aren't any S corporations, but there are a few of those kinds of co-ops out there. There's the pass-through business deduction, which is probably the most important thing tonight to talk about. And then the depreciation changes, meals and entertainment and transportation, which will have some effect on pretty much every co-op here. And then just talk a little bit about the state tax conformity, which means the federal government passes laws and then the states have to decide how much they're going to adopt out of that new rule. So we'll talk about that just a little bit. So I wanted to put this slide in here just to say that you will have some questions about what you need to do in your co-op, and you may need to think about changing strategies or allocating things a little bit differently. You'll have new documentation rules that you'll need to pay attention to. So there are certainly things that you need to be doing in reaction to this new tax law. And it may be that all this doesn't come out until next year as far as changes to your organization, but it's at least good to have a little inkling of the changes that are coming. And then just to say that this applies to your 2018 tax returns, and the way that law was passed, it really only goes through 2025. So that's a long time, but it's not indefinite. So these rules may largely revert to what they were in 2026. So that could be a potential issue. Oops. And so the major headline issue in this new tax law is that the corporate tax rate is now a flat 21% instead of a graduated 35%. So that means that large corporations got a really big tax cut. If you're making $500 million a year, that 14% difference is a lot of money. And so the way the law is actually structured is a cut of $6 trillion in the overall budget, and then it's an increase of $4.5 trillion. So a number of the things we're talking about here tonight, and that you'll experience on your 1040 that we're not talking about tonight, is that a number of areas have increased taxes, and some other areas have decreased taxes. So it's not an across-the-board cut. So that tax cut is a 40% reduction for large organizations from 35% to 21%. So the previous rates were graduated starting at 15%. So actually for small co-ops that are corporations, taxes will be higher now for taxable income that is under $90,000. So that's almost all the co-ops that I work with. So that's unfortunate, and it it does mean you have to think about a few things about where you want to pay your tax if you're, if you're a co-op corporation. Now, if you're a partnership, those things don't apply. But I do want to go through one other thing that applies to co-op corporations. And this will take a few slides to go through, but then we'll get to the things that are relevant to all co-ops. But the first thing is that net operating losses currently, this means if your co-op corporation has a loss, you could carry it back 2 years or forward 20 years, and it'll offset 100% of taxable income. So that is a good thing. The new law allows no carryback. It has unlimited carry forward, but you can only offset 80% of your taxable income. So that means losses for co-op corporations will be of less value, with losses starting with the current year tax return. So that means that under the old law, for instance, if you had a profit of $10,000, the second year a loss of $10,000, the first year you could actually carry that loss forward, offset the profit, and have no tax. Under the new law, it's more complicated. In year one, if you have a loss of $10,000, in year two a profit of $10,000, the loss carry forward only offsets $8,000 of the year two profit. And so you end up paying tax on $2,000, and then the rest of the net operating loss is not lost, it carries forward, but it has less value. So there will be some tax planning issues around that. But the big issue for all co-ops is that there is now a pass-through business deduction of 20% for owners. So that was intended to equalize taxes with other entities and with the large corporations. So this was a last-minute addition to the tax law, and it has a lot of confusing provisions in it, so we're only covering the highlights here. One thing to remember that I'll stress over and over again is it only applies to the profits of your co-op and not to the compensation for services. So that means that in the co-op corporations, you get a W-2, and then you also can get patronage dividends. So only the patronage dividends are eligible for the 20% pass-through business deduction. And if you're an LLC taxed as a partnership, you will get guaranteed payments. That's what your payments for your work are called in a partnership. And then you also get a profit allocation on your Form K-1. Only that profit allocation is eligible for the 20% business pass-through deduction. So that means for these and a few other reasons that the patronage dividends and the profit allocation are more important going forward. So you want to emphasize those, or at least think about emphasizing them in your planning for how you're going to pay yourselves. Because that part of your compensation, only a portion of it will get taxed. And we'll go through an example a little bit later. So the 20% pass-through business deduction only applies on your 1040. So your co-op can make you eligible to receive it, but there are limitations on your overall personal income and your deductions. So, and it's going to be sort of complicated, and the IRS has not fully let us know how they're planning to set up their forms or implement this. So, so we have to wait and see. But what everybody knows right now is that you'll pay tax on less of your income, which is always a good thing. So the limitations are that if you're below these levels, the 157,500 for single filers or 315,000 for married filing joint. So if you're under those limits, that 20% pass-through deduction applies to you, and you can take that on your 1040. If your income is at or over those limits, then there are two limitations. And I know this probably doesn't apply to very many worker co-ops, but there are high income limits on certain professions. So if you're over those numbers that we just looked at, and you're in any of these professions, which includes consulting, which is probably one of the main ones, and then accounting, as the principal business of your co-op, then you potentially won't be able to get that 20% pass-through business deduction. The other test that applies if you're over those high income limits is that if you are not in one of those professions on the last slide, then you may well be subject to a W-2 reduction, which means that basically your business has to pay wages to people to be eligible for this deduction. So, and again, that could potentially be an issue in some of the LLCs because they may not have any W-2 employees. So if you are in the high income area, you may well not get this deduction at all. So the next thing is that if you have any losses, which the profit allocation sometimes in an LLC may be negative. Also, there is the option for co-ops to allocate patronage dividends when there are losses so that the individuals can take that loss. Those will carry forward and offset future profits, so you can't juggle your income to have a loss one year and then have a bigger profit the next. The two years will offset. So all co-ops are going to have depreciation changes. So this basically means if you buy anything significant, equipment, machinery, something like that, you will be able to write off 100% of it now, whereas previously it was 50%. This is something that has changed a lot of times over the last, however many years, many years. During the recession, they actually increased it to 100% and then they cut it back. So now it's up again to 100%, although it will change again in the future. So the other thing is that Section 179, which is the expensing, increased quite a bit. So for most businesses, this is not a big deal. There is some tax strategy around it where certain things are now eligible for this Section 179 that weren't before. But for most co-ops, it won't really matter that much for the time being, since the bonus depreciation is always already 100%. And when I was mentioning conformity before, most states, including New York, do not conform to the bonus depreciation rules. So that means you can't actually use that to write off 100% for your New York tax return. For New York, you can use the Section 179 rules. So that's where you and your accountant need to talk about your strategy for completing your tax return and whether it makes sense to take one or the other to maximize or to minimize your taxes between federal and state. So, and one other thing is that if having a large loss won't be as beneficial going forward, so you may not want to use the bonus depreciation to create a large loss, which then carries forward as a net operating loss, which is now going to be limited under the rules that it can only offset 80% of income. The next thing that affects all co-ops and actually affects almost everybody is the fact that meals and entertainment is now tighter than it used to be. So if you have entertainment, which I know most co-ops don't, like if you have a skybox for the Mets, that's now 0% deductible. Your business meals continue to be 50% deductible, but everybody thinks that the documentation requirements are now increased. So you need to make sure you are differentiating between a meal that is entertainment and a meal that is business. So it's a good idea to write down who's at lunch or dinner or whatever it is and what you talked about. Not in detail, but just generally. You talked about, selling them more product, or you talked about buying a service from them, or whatever it is. Meals while you're traveling are still 50% deductible, but again, you need to document who's traveling and why they're doing that on behalf of the business. And then finally, another change that affects some co-ops pretty significantly is that meals provided by the employer are now only 50% deductible. They were previously 100% deductible. So this means if you have, say, a group meal where you go out to a restaurant, that may well now only be 50% deductible. So that's one where there's some gray areas between these different categories. So you have to think about that. There are some co-ops where they feed the staff. This even applies potentially to coffee provided by the co-op, but that's only 50% deductible if the co-op pays for it. So again, some co-ops that's a big effect. Many co-ops it doesn't change anything. One thing that affects some co-ops, especially in New York City, because you do have requirements to provide employees with transportation, giving them subway passes or bus passes, helping them commute to work without using a car. That is now going to be non-deductible. So that means that if the employer, the co-op pays for it, the co-op can't deduct it. There is transitcheck.com, which I've talked to a number of folks about, where the employee can get reimbursed pre-tax for that. But if you do that, the pre-tax portion that the employee is not paying tax on, the co-op can't deduct that as part of its deduction for wages. So that's potentially a difference between how your taxes were last year and now in 2018. The other thing is that if you pay for parking, which I know most co-ops don't, but a few do, but if you pay for parking in an area where other people would normally pay for parking, then that expense is not deductible to the co-op anymore. So previously that was limited, but it was limited to a very high number, and now it's actually been eliminated. So this has a really big effect on a lot of nonprofits because there's actually a way that they end up getting taxed on this, even though they normally don't pay tax. And then the last thing here is, although it was a small benefit, the bicycle commuting allowance is no longer allowed, so that can't be provided at all. So those are potentially big changes for everybody. One strategy issue, and this especially applies to LLCs, is that it's a good idea to reimburse yourselves for expenses. It actually reduces the amount of tax you're going to pay and makes it clearer about the expenses if you reimburse yourselves as opposed to claiming it on your personal tax return. Most of the time, this is only affecting LLCs, taxes, partnerships, but can affect other groups as well. And then we'll skip over this about the real estate. I don't think most folks are getting grants for real estate. We already talked a little bit about the tax conformity issue, that most states are not going to adopt these rules. But there is then an issue that I wanted to get back to, and we'll talk about it a couple of times in the balance of the talk, which is that there are now these tax advantages. So you have to think about the fact that when your partnership LLC is paying out profit allocations, that the members potentially are paying less tax on that. So you want to make sure you're doing that. In a co-op corporation, there's now a question of, should you let the co-op pay tax on it, or should you allow the members to deduct it? So you want to think about how you're saving for reserves, and again, we'll talk a little bit more about that later. So there's now a tax advantage for showing more profit and less wage. So you want to think about ways that you can do that. I just had a conversation with a co-op that normally pays bonuses, and they've now decided instead of doing bonuses that go on their W-2, they're going to start doing that as a patronage dividend allocation because they're a corporation, a co-op corporation. So that potentially will save them a lot of tax. And there's a couple of ways, since we only have a few minutes left before we want to get into questions, is that in co-op corporations, typically if you do a patronage dividend, that's not subject to payroll taxes. which can be a really large savings because the Social Security, FICA, and Medicare, between the employer and the employee, that's a 15% tax. So not having to pay that makes a big difference. That's not something that's eligible, that partnership LLCs are eligible for. But they have other benefits up front where there's some taxes that they're generally not paying. But everybody should think about, if they want to have W-2 wages versus having a profit allocation. And then I'll just go through, there's a few numbers here, and then we can stop and see if there are questions. But just to show the benefit of doing the patronage dividend, if you have somebody who's getting total compensation of $40,000 in a year, if you divide that up to be $30,000 on their W-2 and $10,000 on a patronage dividend, then they'll save income taxes of $240, and this is for a co-op corporation. And then potentially they save payroll taxes of $1,500 or more because there are potentially also state unemployment taxes, workers' compensation insurance that you don't have to pay on patronage dividends that you do have to pay on wages. And then the second example is for somebody getting paid more, the benefits compound for people at higher income. So something to think about. Now in a co-op partnership, if somebody was getting $40,000 in pay and you divide that between $30,000 for their guarantee payments and $10,000 for their profit allocation, they're going to save $240 on their federal tax return. So it's not a huge amount, but it's certainly more than nothing. And if you multiply that across your co-op, everybody could be saving, a few $1,000s. And again, at higher compensation levels, then those numbers increase. So, I don't know when you want to break for questions. Somebody could just wave at me if you want to do that. Otherwise, I can keep going to a few more slides.
Why don't we break for questions now, and then we'll come back and do the rest of the slides.
Okay.
Chance for any questions that have come up. A few notes. Interpreters, I can't see your video, either of you. So if you're making hand signals, I'm not able to see that. And we do have one person on the Spanish line. And I can see if anyone on the Spanish line has questions, please press 1 on their phone keypad, and I'll be able to see that. Otherwise, for folks that have questions on the line, we'll see if we can just do folks asking the questions without it getting too chaotic. If it's too chaotic, I'll figure out another system. You can also feel free to put questions in the chat and I'll make sure they get asked. So a chance for questions from anybody.
If you have any questions, you could just go to see Raymond after.
Anybody have any questions?
I have a question.
Yes.
So if you are still less than $10,000, but you're paying for MetroCard fees for the people that are in, like your associates, how do I report that? Because most of our co-ops are still in the pre-startup stage, startup stage, but I know that we still have to report things that go out. And what particular schedule is the main schedule that we got to pay attention to when we're first reporting our taxes?
Sure.
For LLCs and corporations.
Great.
Sure. In the startup phase, and this is especially important in New York because they enforce this, is that you want to start filing from the day that you register with the state of New York. So that may mean that you have no activity at all in your first year. So you'll need to pay attention to when you incorporate because the state actually enforces that they want a tax return from that day forward. And so on the LLC partnership, it's a Form 1065 is the federal form, and then there's a state and a city return. But on the federal form, it depends on if you have any income. If you don't have any income, then those expenses just get what we call deferred, which means they carry over from one year to the next. So if you have expenses in 2018, but you don't actually have the co-op started, then you will you'll file a tax return that will basically have 0 on it. And it will be the same for a co-op corporation. If you have income, you can start deducting those expenses. But if you don't have income, you need to carry them forward. But what you need to do is keep track of all that, and so that you can deduct it when you do start having income for your co-op. So it's important to keep track of those expenses and fees and all those other things. And that may be, it may be an investment in the co-op. It may be something that the co-op owes you as a loan. So you have to decide what the nature of those expenses are.
Can I ask a follow-up question to that? Where can I find what category of investment payments I make as a cooperative that is tax deductible?
It's taxed as a what? I'm sorry.
That is tax deductible as an LLC and then as a corporation.
Sure. Well, anything that's necessary to run your business is going to be deductible. So that can be really wide-ranging. Certainly any fees that you pay to the government or pay to an attorney or pay to a consultant, those are all expenses that you're going to be able to deduct, and you just have to, call that professional expenses or government fees or whatever it is. And then as far as the other side of that, it depends on the rules of your co-op, whether that's an investment in the co-op. For instance, it's you're building up your member equity, or if it's some other kind of equity, and that would count in either an LLC partnership or in a corporation, that you can build up equity in either of those kinds of entities.
Bruce, there's a question from the chat that says, are these 20% deductions automatic?
No. They're going to be applied on the Form 1040, and the forms that they're going to use for that have not been released yet. So we don't actually know exactly how the IRS is going to want it reported, but I'm sure there will be a new form, and you'll have to enter the amount on that form and say that it's eligible. And you'll probably have to check some boxes saying, what your profession is or something like that, and then it will flow through onto your 1040. So it won't be automatic.
Great. Any other questions? You can either put them in the chat. You can press 1 if you're on the Spanish line, or you can speak if you're on the Zoom line. I muted some of you on the Zoom line, and I'm not sure if you'll be able to unmute yourself. So if that's the case, you can also put questions in the chat.
I have a question.
Go for
Can
it.
you hear me?
Yep.
Great. So it's on business expenses. So for an LLC with multiple members, would you suggest they submit expense reports to claim like mileage and home office use?
Yes. Yeah, that's a cleaner way to have those deducted. And so, yes, they just need to submit that so that you have some receipts to show that it was a legitimate expense. And then you reimburse it. And then it also helps you set some policies on how you want to what you want to reimburse people for.
Okay, thank you. A second question. So our co-op will be providing housing for a couple target markets. So we will eventually acquire a building. Mm-hmm. So would the cost of the acquisition be taxable?
No. If you borrow money to do that, then that borrowing is not income. And then the expense of the building will be partially deductible as depreciation. So that stretches out over a long time for a building. But there's certainly not any income up front unless you're getting a grant from somebody to buy the building.
So if we do get a grant that's for 100%, it's 100% taxable as income?
Unfortunately, yes. That's part of the new change that I skipped over, is that grants from a nonprofit or a government that are used to buy real estate are all income when they're received. So that is a very unfortunate change in the tax law, but that's what it is.
Thank you.
Great. Any other questions? You can put them in the chat. Press 1 if you're on the Spanish line, or just ask if you're on the phone. We're getting a rotation of green marker questions. So before you go, no worries. Before you go, Danielle, it looks like there's a question in the chat that's related to the last one, which is, what about grants for a program like a class?
Grants to a co-op are going to be taxable. And so if you get that grant in 1 year, but you haven't spent it, if you're what we call an accrual basis entity, then you can carry it forward. But if you're cash basis, or if you spend it all in 1 year, then it's income when you get it. So yes, the government doesn't recognize grants or gifts to corporations or partnerships. So that will be income, generally speaking, when you get it.
Great, thank you. Okay, Danielle, go for it.
Well, the question I had was related to that because we had a couple of co-ops who did receive scenic grants. So that has to be categorized as income is what I'm hearing. And then I have a second question if that's...
Yeah, go for it.
Okay. Can you talk a little bit about what an S Corp is and whether you think it's beneficial for co-op corporations to apply for that?
Yeah, an S corporation is an older form that's taxed similarly to a partnership. It's what people had before there were LLCs. LLCs are a relatively new thing. But an S corporation is a regular corporation that elects to be taxed under the subchapter S. And the members get a W-2 and then they get a profit allocation. Generally, it only works in co-ops when it's pretty small. There are limitations in S corporations that you can't have more than one kind of equity. So you can't have preferred shares. You can't have classes of owners, which bigger co-ops oftentimes have those. The primary advantage is that it's very clear that the profit allocations in an S corporation are not subject to self-employment tax, which is a good thing. But again, it's hard to allocate profits because the way the IRS rules work, you have to allocate your profits based on your percentage of ownership, which generally co-ops don't want to do. But if you had, let's say, just 3 or 4 or 5 members and they all work roughly the same amount, then that ends up about the same as a patronage dividend anyway. So, but S corporations can be useful, but you know, there aren't very many of them out there.
There was a question from the chat. Is this new tax law change, is the way the tax law impacts grants different than before? This person thought that they were always treated as income before and after this tax law change.
Grants for services and so forth have not changed. Only grants for real estate have changed. So, yes.
Okay, great. And then there's another question in the chat. It's Edith from Damayan Co-op, and she asks, what if a co-op is just funded or incubated? Is it taxable?
Yes, if there's income and not expenses, then you are potentially paying income taxes on that. If you get a grant and you spend it all for attorneys and you know, consultants and fees, then your expenses will offset your income and you won't pay tax. So it is taxable, but you may not end up paying tax if you have expenses to offset.
Great, thank you. Go ahead, Rayblin. Is that Rayblin?
So another question I have is like, what if you were a startup and did not report your taxes in the past year or 2? What are the penalty implications of that? Because you just didn't know.
Sure. For partnership LLCs, it's actually, it can be very expensive because there's a very large penalty for filing late if you need to. And so, you know, unfortunately, there aren't very many choices besides filing, but you may end up having a large penalty for filing late. If you're a co-op corporation, there are only penalties if you owed tax or federal. For state, there are some late filing penalties, but it's fairly small. You know, if you're an LLC partnership and haven't filed for a few years, you may almost be better off dissolving and starting over again, just because the penalty is $195 per partner per month. So the penalty is really large. So you have to think about that.
Okay, and there's a question from the chat. I think just wants you to repeat something just to make sure I heard you correctly. With an S corp, the profit allocation must be explicitly calculated on equity percentage only.
Right. Yeah. The rules around S corporations are very strict. You can lose your S corporation status if you don't follow all the rules, and that is one of the rules.
Cool. I want to invite, if there's any last questions from Green Worker, I know the Green Worker crew is going to have to hop off, and we're going to go back to the presentation of more information. So last call for questions from you all, and then.
My question is, last call is that, are you available for private hire for various co-ops to be able to be referred to you?
Yeah, sure. My email address is at the end of this presentation, and I'm sure you can get it from anybody there. So yeah, be happy to talk to people.
It looks like we
One more question.
Yeah, go for it.
Hi. So our co-op is incorporated, but we're a C Corp as opposed to an S Corp. When I did the inquiry with IRS, they said we could change, but then I was listening to what you were saying, and probably it was set up as a C Corp because it has preferred shares. Right now, it's just two of us, and we don't have anything to write off at this point. So we're not required to file till next year, April. So what is your recommendation at this point? Should I just leave it or look into changing it?
No, incorporating as a C Corp probably means that you're a co-op. So traditional co-ops are C corporations that just act like co-ops. So I think you're probably fine, assuming you want to be a co-op, you're fine just where you are. And then, the tax return that you file next April will be for 2018. So if you have any activity in 2018, you'll want to summarize all that so that it can be reported next year. And it should be fine. You don't want to file to be an S corporation.
Okay. Thank you.
Yep.
Okay, great. So I just want to, one more question, and then we're going to go back to presentation. What are the mandatory reports to be submitted by a co-op corp to the government?
Sure. Co-op corporations file a Form 1120C. So that's the federal form. And then I don't recall the numbers on the New York forms right off the top of my head, but there is a New York corporation tax return that you have to file. And then there's also a New York City corporation tax return that you have to file. So you do have those, but the starting one is the 1120C for federal. And then if they want to email me, I could give them the exact numbers for the New York return. It's an NY something, but I just don't remember the number.
Okay, great, thank you. Okay, why don't you go back to finishing the presentation and whatever you didn't get to, and then we'll do if there's more questions at the end.
Okay. So let's see. Okay. So the next slide is about worker co-op strategies. So I've already talked about this a little bit, but I have a couple of slides related to this because I really want to emphasize it, partly based on my experience with a few other co-ops, thinking that this would be a really big tax break for them. So that 20% pass-through business deduction, that increases with your the amount of income that you're allocated through your patronage dividends. So patronage dividends have that advantage, but they also generally will avoid payroll taxes. And then they will avoid unemployment comp and workers' compensation insurance. So the potential savings are really quite significant. And then the other advantage with patronage dividends is you do get to think about, do you want the worker to pay the tax or the co-op to pay the tax? One advantage with patronage dividends is that if you're a calendar year, for instance, and the co-op, you get into early 2019 and say, oh, we had a profit. What do we want to do with it? You get to talk about what you want to do. And then if you decide to pay it out, the co-op deducts that back in 2018, but the individuals will recognize that as income in 2019. So there's actually a 1-year delay in when the taxes are paid. And then I just wanted to give an example of what the tax rates are. They're different for married filing, joint, and for other classifications of head of household and so forth. But basically, these are the tax rates that people would be in. So, if you're $0 to $12,000 of total income, you wouldn't pay any tax, no income tax anyway. And then 12 to 21,000 in the 10% bracket and so on. So you can compare what your members will be paying in tax to what the co-op would be paying in tax. One thing to remember is that this generally applies only to the patronage dividends, because if you add on payroll taxes to this, then somebody who's in the 10% bracket is paying 10% federal income tax. They're also paying essentially 15% for the FICA Medicare plus unemployment plus other things. So the rate gets significantly higher. But on a patronage dividend, somebody's paying at that 10% rate, and they may actually be paying less because of the 20% business pass-through deduction. So there are good reasons to allocate your income to patronage dividends now, but with the 21% lower rate, it's at least for large co-ops, potentially there is some savings leaving things in the co-op. But for most co-ops, when your members are not paying high income tax rates, you're probably better allocating it to them and having them pay the tax, or having yourselves pay the tax as opposed to having your co-op pay the tax. So that'll be an important one to think about. And then just a couple of other things with patronage dividends. You are allowed to allocate those to people, but then retain a portion. So you can award somebody a $100 patronage dividend and then keep 80% in the co-op. The individual has to pay tax on the full $100. But it is a way to have the individual pay the tax at the lower rate, but keep the money in the co-op. And just to mention that the self-employment tax issue on patronage dividends that I mentioned that you get to save, it's not a fully settled issue. And so it comes up occasionally with co-ops, and there are some co-op attorneys who are attempting to get the law changed so that it is a settled issue, but it's not there yet. So basically, if you're getting paid through a patronage dividend for your compensation for your services or the work that you do, or for being on the board of directors or something like that, that really should be subject to self-employment tax. But if you're allocating the profits, which means you own this business, what would a business owner normally get as return from this kind of business? If you're allocated that profit, it should not be subject to the self-employment tax. So that's an important distinction, that people need to think about. And that relates back to that fair compensation issue I talked to you about. You don't want to start thinking that you want to take 100% of your pay as patronage dividends because you save all these taxes, because the IRS is not going to like that. They haven't released the exact recommendations that they have on this, but certainly if more than about 1/4 of your compensation is through patronage dividends, the IRS has the potential to object to that and want to charge you more in taxes. So a good thing to think about. And then really that was about it for what I was going to talk about. The takeaway from this, I think, is that everybody should be considering if the meals, the transportation, the depreciation, and those patronage rules, or the 20% business pass-through is a benefit that would be useful for your co-op. And then to make sure that you are documenting your business expenses, especially around meals. Although it's highly unlikely that you would ever get audited by the IRS, you have a slightly higher chance of being audited by New York or New York City. So you always want to make sure you have your documentation in line. And that was really it. I'm happy to talk more about this. I could have talked much, much longer, but I wanted to keep it short, and hopefully you're retaining at least a little bit of this after tonight. So any more questions? I'd be happy to go through that.
Great, so we'll open it back up to questions. Anyone have a question? You can put it in the chat, or you can just speak up. Some of you are on mute, and I'm not sure that you're all able to unmute yourself, so feel free to put things in the chat, and I will make sure that all the phones are unmuted. Oops, sorry about that, everybody. Okay, sorry, got the problem. So there's folks would like the slides to be sent to you. So we'll see if we can send it out to those who attended the webinar later this week. I'm getting a few email addresses in the chat, and I'll try to keep track of that, but we'll also just try to send it out this week. Any other questions that anybody has? We do have another 15 minutes, so if anybody has questions, now's the time to ask them. Bruce, if there's no questions and there's anything else you want to add that you skipped or left out to keep short, you can also feel free to do that.
Sure.
If you're on the Spanish line, feel free to press 1 on your phone pad if you have a question. So just open up for questions. If not, we'll give the floor back to Bruce to keep telling us important things. Do you know any CPAs in New York State that are also well versed in this?
Actually, I don't. I think if you were to ask at at Urban Justice Center and a few other places, you might be able to get a few names, but or ask at ABC if they are aware of anybody. But generally speaking, we haven't found anybody who has taken a lot of time to learn more about co-ops. But certainly there are a few people here and there, but I don't know who they are.
Okay. And any other questions? Okay, Bruce, if there's anything you want to add, and if folks have questions, feel free to just speak up or put things in the chat.
Okay. Well, one thing I'll say on this last slide is that there is a link there to our website, and that link, the bottom link there to industries/cooperatives, is a co-op blog. And so on there, we have a number of articles going into more depth in what I talked about tonight, and then a lot of other topics. It's all accounting and tax, so you have to be prepared for that. And then if you go back up one level from that, there are some articles on things like best practices for internal controls and more explanations about what a balance sheet is and an income statement and so forth. A little bit about monitoring your cash flows. Those were all written for food co-ops, but they apply to any cooperative. So I would urge people to take a look at those. And I guess you just want to make sure that you think about that you want to have profit allocations and patronage dividends. And if you can't rearrange things in your co-op, because it takes a little bit of time to do that, you'll at least want to start doing it for 2019. So that's really all I have. I always like to finish meetings early, so certainly if people are done, but I'm happy to stay.
There's one other question. To whom do we email if we have any questions regarding the filing and other questions?
Yeah, my email is on that last slide. So it's just brucemayer@wegnercpas.com. And it's on the slide, so you'll get it emailed out to you. And certainly Tammy and Danielle both have my email, so they can forward that to you if you let them know.
Great. Anything else? Happy to end 15 minutes early. But if there's anything else, this is the last call for questions.
It's on mute. Hi, I really just want to say goodbye. I see us, but
Thank you.
Thanks. Anyone else on the video or on the webinar have any last questions before we let Bruce go? We're seeing a lot of thank you and thanks a lots in the chat. So thank you, Bruce. Thanks a lot, as the chat is saying. You'll have his contact to get more information. And just for folks to know, we'll probably do another tax program in person in January or February as people are preparing their taxes. So just know that as well. And someone said, come to New York City and we'll buy you real bagels.
All right, I'd be happy to do that. I get to New York City about once a year, but I'm happy to come again.
Okay, great. Okay, cool. Thanks everyone for joining tonight. We do have this recorded. We'll also try to share the recording, and we'll try to share I got to figure out the technology, but I have folks here to help me, and we'll hopefully send stuff out. So thanks everybody, and have a good night and sweet dreams about taxes and savings. Bye everyone.
Thank you.